Good afternoon, everyone. Welcome back to the Schwab YouTube channel. Our next topic is building a stock portfolio, and I'm your host, Kevin Horner. I'm a senior manager with the Schwab coaching team here out of Denver, Colorado. I'm pleased that you're all joining us today. Today's market was very interesting. We had a nice little rally in the morning. Looks like we faded into the afternoon. We'll talk a little bit about some of the headlines that might have led to some of the pullback we've seen this afternoon. And we're going to talk about that broad market move. We're going to talk about our example portfolio, which, as you may imagine, experienced quite a few stopped out positions over the last week due to some of that volatility. So we're going to look at those. We're going to also look for new opportunities to dive in to the market here today. So we're going to cover a number of key points. So before we get into it, I want to remind you we're joined by my friend and fellow Schwab coach, Connie Hill, in the chat. Connie, a fantastic coach, has been doing this for a very long time. She's a chartered market technician. We'll have answers to questions that I'm unable to get to, but you know I'm going to keep an eye on things. Thank you, everybody. I'm glad you like the Think or Swim shirt here today. It's my first time wearing it. I absolutely love it, mainly because I'm a big believer, a big fan of the thinkorswim desktop application. And even though I've only been using it for about 2.5 years, it's been quite the steep learning curve, as you all know. But I'm pleased to get to talk about it, use it every single day. If you're not already doing so, everyone, make sure you're following Connie and me on X, Connie Hill, CS, Kevin Horner, CS, and you want to make sure you're subscribed to the YouTube channel. So if you're visiting us on that channel, make sure you hit that subscribe button. All right, with that, let's get to our disclosures so that we can jump into things. Please remember that everything we cover for you today is considered informational and educational only. We do not make recommendations. We do not make endorsements for any specific approach to trading the market here. We will utilize technical analysis, though, as we review the market today. In doing so, just keep in mind, technical analysis is just one decision-making point. It is not the only basis of decision, so try not to fall prey to utilizing only technical analysis in decision-making. Additionally, remember that we work in a paper money version of the thinkorswim desktop application. Now, some of the scanning tools that we incorporate, you'll just want to remember that the study details are not available in the thinkorswim desktop paper money. You do need to use the live version, of course, in order to incorporate those specifics in your scanning abilities. But hopefully that doesn't keep you from utilizing the scans that we have available. And of course, if you're catching us in the archive, those scans that we do share in class can be found in the show notes down below. So check those out if you'd like. Okay, let's take a look at what, oh yeah, we should also, there I got my paper money detail on my disclosures. Let's jump right into the look at the market here this afternoon. We've got the S&P 500 up here. This is my intra-period chart, as you can see, everyone. And, you know, I was talking just earlier today with Nicole Petalides on the Schwab network. That, of course, is a third-party affiliate of ours owned by the Charles Schwab Media Corporation. The importance of our move today, or maybe the significance of the move, was the level to which we rallied right into the 20-day moving average today. But we did not break through it. Not only did we not break through it, everyone, it's not like we've stopped up there at the close. We didn't have a big, beautiful green candle at the close, do we? We have what appears to be a rejection candle. Now, it's too early to call it perhaps a rejection as such, but ultimately, the fact is we have only in the last 20 sessions here been above the 20-day moving average for 4 total sessions. 2 of them came right here. If you were utilizing, or let's say you had created your own definition of confirmation, needing 3 closes above an area you deem to be resistant, then you might have been capable of avoiding buying on day 2 here. Had plenty of reason to consider it a decent day. We were 2 days in a row closing above both the 20 and the 50. Some traders would have jumped on that. Others would have waited for more confirmation, and they would have waited for that 3rd day. Well, we didn't get it. So if we go back to the total of the 20 days, the 19th and 20th days are these 2 right here, these next 2 red candles where we were above it and made a lower high. In fact, I could also draw in a key level of resistance here from the technical analysis 101 viewpoint, that being our peak down through our next peaks that are all lower highs. So have we put ourselves in a position to continue to the upside? Unfortunately, not as of yet. We do probably need to remain a little bit disciplined in our view of things here, simply because, as you can see, everyone, we don't, as of yet, have the confirmation for which we strive, right? We are constantly working to get that confirmation that gives us the confidence to trade on the bullish side, but as it relates to the S&P 500, perhaps it's still not necessarily there. So perhaps just a little bit of near-term patience as we try to figure things out in the S&P. Now, part of the reason for the afternoon delay, if you will, the slide that we've witnessed in the SPX, the NDX, the RUT, all of them has largely been to oil, and oil has continued to be a struggle for us. As oil goes up, we have seen our markets fade, and so when we had the oil move today, what we had was a very significant move lower over the last 2 days in the price of oil. Remember, this is a futures symbol, everybody, and futures certainly as options, futures and options trading not appropriate for all of us as traders, but I'm going to incorporate it just to highlight some of the difference we're seeing here. Remember, we got up to 119.5 almost there in the Sunday overnight session and have since seen oil pull back 28% to our current level. But look at how far we've already moved off today's intraday level. We're already up 12% from that. And so some of the discussion here is around the Strait of Hormuz, also tied to the potential that we've seen a headline that read, hey, there's an opportunity to see Iran actually placing mines in the strait, which would be very difficult for us, of course. I gotta say, we have to keep this in mind. We know it is a headline-driven market. As such, some of our technical viewpoints might not be playing out the way that we would expect. Now, how do we traders take an approach that lets us be involved even if things aren't as comfortable? Well, one of those key components is simply management, trade management. If your lack of comfort is keeping you from participating, one of the things that some traders consider is to enter smaller position sizes. And if you're new to this class in particular, I'll bring up my scratch pad here and highlight what we try to discuss and cover in our review of the broad markets here. When we take position size, we take a position size not to exceed $10,000 if we do so on a full position. But if you're not comfortable and if you're wanting to participate based on your familiarity with technical analysis or your risk tolerance, but you're still a little bit unsure about things, rather than you can do a couple of things. Obviously, it's okay to not trade. Don't misunderstand. But if you wish to be involved and you wish to try and take your shots, you got to do it probably with smaller position sizes, which will lead you to lesser risk, of course. So that's one of the key takeaways as it relates to building a portfolio and trying to stick with it. So we have a little bit of a questionable market as it relates to our S&P 500. Certainly in our NASDAQ 100, we can see something similar. As now, the benefit of the NASDAQ 100 is the recent test of our 200-day moving average, that being yesterday. Many a trader is going to tell you that they're comfortable for as long as we hold that 200-day moving average. Look back to when we got above it in May. We've held it since. This is our first real attempt to test that ledge. And you can see that we've had a few minor machinations beneath it. They've been very limited in scope. 1 day, 2 day, right back above it. So if nothing else, bullish traders know that they would likely get much more defensive if we witness the NDX closing below that 200-day moving average. Now, that stated, It doesn't mean that you have to believe that we've got upside from here, right? Again, look at the difference in the moving average. See where we are here. If I hid this and put up only the 50-day, we have been below the 50-day now all the way back to when we broke down here in early February. So we've basically got 5+ weeks below the 50-day moving average. And if you're a trend trader, that tells us that we are either in a neutral trend or perhaps short-term to intermediate-term bearish. Remember, bullishness above the moving average, right? And then below it, the difference between, for example, this very brief window and this much longer window, right? So quickly below it, right back above, 1 day below, 2 days below, right back above, 2 days below, right back above. This one stands out, right? And so traders should probably be a little bit disciplined as it relates to the NASDAQ 100, heavy on tech. Today felt a little bit better for half of the day following through from yesterday's fantastic finish. And then today's move just did not stand to close at our highs, which is ultimately what we would have liked to have seen. So we could also say that something similar happening there with our Russell 2000. Again, we don't like these candles that finish like this, right? These have the makeup of, hey, we got up to that level where we really thought we had bullishness. And instead of bullishness, we had volume of sellers positioned, ready to sell into that level, and that pushed our prices down. So this is not an ideal setup on even the small caps right now, but we know levels where we would feel a little bit different. Okay. Now, I understand that we've obviously got a number of key positions that we got stopped out on last week. So let's review our example portfolio and see that we have a whole 2 stocks in there. Last week at this time, we had 6. We were building out another trade to get us into a new one from an example standpoint. But let's take a look at the ones that we've been stopped out on. We'll start off with our Caterpillar trade. We had done really well on Caterpillar. Let's put up not just, I've got this set so that I can see open orders, but as you can see, we're out of CAT. So I'm just going to adjust this to show my trades, and it's going to highlight where we got in right here after confirmation of a 50-day moving average opportunity. And we got in at 624.25. We got stopped out when we traded below what was our 20-day moving average. I'll put that back up here for you, everybody. So I'm going to have to there we go. Okay, those are still there. So we got stopped out when we broke the 20-day by the amount of our average true range, the ATR. But the good news is, in the case of Caterpillar, we had an excellent trade. We should be very pleased with ourselves. We managed it effectively. We could have held if we were working with the 50-day moving average. We could still be in the trade, but we were tightening up along the way because we wanted to capitalize and take profits where we could. And that's exactly what happened. We ended up profitable by about 74 points a share on our small 15 shares. Now, at this moment, there's no reason for us to reconsider Caterpillar. We could give thought to this, but we're going to try and move on. And my thought generally is in this class is to keep looking for new ideas rather than coming back to the same positions. It's nice if the trend is still working. We can always give consideration to it. But my thought is let's find more individual symbols, more examples. More examples offer more insight for the trader. So the more individual symbols we can see, the better is my thought. Okay, so moving on from CAT, we also had a newly established trade in Amgen. This one we got into just a couple of weeks ago, as you can see, and unfortunately, we got stopped out on it on the day we broke the 20-day with some big conviction. Again, we work to set our exit strategies approximately 1 ATR below the preferred or the current supportive simple moving average. And so we've been a lot of these trades using the 20-day simple moving average. And I'll remind you, the ATR is the average true range. So ATR, average range of the stock for the last 14 trading sessions, which gives us a little bit of an insight as to our ability to maintain the position for as long as possible. What often can happen, as you'll see in some of these positions, everyone, we see the CDC or our CDE, excuse me, and our EXC trades. Sometimes broad market weakness will take you below a supporting trend line, a dynamic moving average like the 20-day. We don't mind getting stopped out. We recognize it. It's part of the business, right? It's part of doing this approach. Part of trading the market is getting stopped out of your short-term positions. But what we want to do is get stopped out ideally when the trend breaks. And in our example on Amgen, it did break the 20-day, and now we're actually testing the 20-day as resistance. Remember, we can always bring back our standard technical analysis concepts, right? What once was resistance, or excuse me, what once was support in the case of the 20-day here, dating back to January 21, we were above it every step of the way. And then we broke it. Now, while it was support, now it can become resistance. It shouldn't shock us that 2 days in a row, our buyers have lost steam at approximately the 20-day moving average. If we can get through it, terrific. But for now, it's a wait and see. All right, next up on our stopped out positions was Cabot. Cabot here broke down pretty significantly. This is a good example of us wanting to be out of the trade because we had a broken 20-day moving average. We also had a broken 50-day moving average. Now, we got stopped out below the 20-day, but you can see there was a good amount of downside here. This stock pulled back pretty dramatically. Let's see how percentage-wise what we're looking at to where we finished today. How about 10%? Just over the last week, it has sold off. So by virtue of us getting out, we did take a $4 plus loss on this position. So about right around $200 within our tolerance for risk, right? We're comfy losing as much as $1,000 on a trade. But here we limited our loss to about 200 total, and the stock has gone lower. So this is exactly why we incorporate, this process, these stop orders. No, not Kevin, I wanted to answer your question here. Yeah, so the stop is 2% below the 20-day using the ATR. It's actually tied directly to the ATR. So rather than incorporating a percentage below your moving average, we incorporate the dollar amount of the average true range. I'm going to show you an example of building one out here momentarily, everybody, because we do have a couple new example trades we're going to put on, but I want to get through quickly revisiting the ones we've been stopped out so that we can clearly see how it occurred. Here is Tyson, where we stepped in back here on... Yeah, I bought it at 60.21 not that long ago, back in January, and we took it pretty well here, all the way up. Now, we only made about $1.60 a share, but again, look at where we are relative in price to where we got stopped out. So this is okay. This is what we're striving for, right? So again, good example of the trade limiting our risk, because we continued to ratchet our stop orders higher when given the chance. In this class, we only ratchet our stops up, and we only get to do so once a week when we reconvene each Tuesday afternoon. So please keep that in mind. I'm not going to take action when y'all are not here with me. So I want to have the opportunity to discuss it with you. Okay, so there we are. Those are the big four we got stopped out on. We have existing positions in Exelon EXC. We're going to need to elevate our stop here. This is going to give us a chance, Kevin, to explain the ATR. So we're going to go ahead and incorporate it here. Notice, first of all, where our stop is. We're in at 46.18. Now, we're going to take a look at our 20-day moving average. Why? Well, because the 20-day is pretty aggressively upsloping, and we're actually maintaining a level of support horizontally above the prior highs. So this has the makeup, the visual, if I was to maybe draw in the lines here, it kind of looks like a bit of a bull flag, doesn't it? So the view from the bulls would be the 20-day moving average needs to stick. So we're going to take that 20-day, 48.15, we're going to reduce it by the amount of the ATR in the lower left, 97 cents. I'm going to go ahead and round that up to $1 for easy math, and we're going to push our stop to $1 below 48.15. So we can do that by clicking and dragging, taking it up to 47.15. There we go. Make sure it is 47.15, good till canceled. We are good for 179 days, almost 6 months exactly. So I'll go ahead and hit send on that. And now we have elevated our stop properly. And again, you can go tighter than that. You can absolutely go with one of those tails. You know, maybe I go with a low from here and put your stop closer to 47 and change. That's fine as well. But remember, we're working with a plan and a process. And I need to remind you all, as traders, we are over the long term rewarded for the consistency and discipline that we exhibit in our process. So that's our encouragement, is to work with the same process going forward. Try and be as disciplined as you can. And in the instance that that I show here, 97-cent ATR, it's okay to go with a few pennies more, right? Because that means more wiggle room. And as long as we are still comfortable with the amount of dollars of risk we've got, terrific. It's not so wise to go with a lesser ATR, right? That's what we want to remind you of. Okay, so EXC, stop order elevated. Let's check out our other position, and that's core mining. This is a wonderful example of why we didn't get stopped out here, because we did incorporate the proper ATR below our moving average. And so here we've got our stop set. The stock has since rallied back a little bit. It's back above the 50-day, but we probably need to let this go for a bit. One additional reminder as it stands with our stop orders. First of all, I gotta state, when we place these stops, remember, they trigger and then become market orders, okay? So we have no validation of price once they trigger. That means that even though the stop is set at a price around $20, there's no guarantee it's gonna execute at 20. Okay, so we have gap risk. We could open below our stop and get triggered by that open and then sell at the next available price. That could open at 18 and then our exit is pretty close to 18. It's not likely close at 20. Okay, so just always be aware of that. And then the other reminder is that we don't reduce our stop prices. Raising our stop prices, yes. Reducing our stop prices, no. Once we're in the trade, that first stop we set needs to hold, okay? As the stock goes up, terrific. We can work to capture more upside by raising it, but we don't reduce it, because that basically tells us all the work we did in determining in advance what level we wanted to work with, how many shares we should own, and so on and so forth. That invalidates all that work. We don't want to do that. Okay. So there you go, everybody. That's our quick review of the broad market. Subsequently, a review of our example portfolio, which is much lighter today than it has been. Now, let's go forward by looking at some of our groups for consideration of new positions and new example trades, okay? All right, so the first thing we're going to do, I'm going to open up my first watch list. This is energy. I'll remind you all that I have been building very basic, very generic scans here, right? Uptrending all time frames. These are simply trends that are stocks closing above the 20, the 50, and the 200-day moving averages all the while, right? So they're all above those three moving averages at the close of today. So if we looked at, for example, Halliburton, some traders would say, boy, that's a nice possible entry along the 50-day moving average with potentially, new upside, right? We've been holding the 50-day all the way back to the October earnings announcement. It's been like a magnet for us, and entrance along the 50 would be certainly, at least over this window, validating. So perhaps we could consider Halliburton. We could also, as I move on down the list, you're going to find some of these to maybe be a little more elevated than we might like. Here you've got the 20-day moving average. If we would have stepped into Williams when we took out prior resistance back here and started trending, that would have been a little bit more ideal. Surely a trader could work with the 20 and start to establish a brand new position, potentially. What about Valero? Similar, right? Holding up. I'm looking for something that might stand out, though, as nearer the reversal of a trend, right? These are stocks that we're in 1 year trends already, right? And we're trading near highs. These are perfectly fine for traders, but I want to give us something maybe that we have an example opportunity to stick with a little bit longer. I'm looking to catch something, nearer a longer range area of support. These are all bullish in nature. Don't get me wrong, everybody. I'm just looking for something that maybe stands out a little bit more effectively. Can't say I'm finding it here in energy. Like I said, lots of bullish trends in energy, okay, but not necessarily ideal from an example standpoint. Moving on now, we've got next up industrials. We've got some strong positions in here. We tried trading this GE Vernova. We've been stopped out of it previously. This certainly, again, back above the 20. Notice the 50-day moving average in purple there. It's been held a bit. That could work, but we're a pretty good distance away from it. So you're looking at risk of like $100, to the downside to be stopped out, right? So that's a little bit of a trick. You know what? Let's see. Is there anything on the... didn't have anything even in my industrials that jumped off the screen at me here today. I did have some symbols, though, in the staples side of things. Let's go to staples. Let's see. Okay. Archer Daniels. Okay. Now here, I just got done telling you, hey, maybe some of these are sitting at elevated levels. It's a 52-week high, or pretty darn close to it in Archer Daniels, but it's also dabbling with a possible breakout here. Notice the 50-day is not too far off. Okay, so we're about 4 points away, 3.5 points away. That could certainly be an area under which we could place a stop, right? Something like that. Amount of the ATR could be beneath that. That could stand out. So that could work. And you notice, again, this is not a bearish scenario. Certainly you've broken through, held the level, and consolidated. A lot of traders would say this consolidation is what's bullish, and then the opportunity to break out to the upside. You're basically looking at about a $5 range, and if it can break out from that, you might have $5 to the upside, is one way to give thought to ADM here. Look at this on the weekly. The other thing that might catch your attention, everybody, as we move into a weekly view, why might a trader want or be more willing to potentially step into something like ADM when you look at this on the weekly? There's a couple of things that stand out here. We've got a long range downtrend that was broken with some of this recent price action, right? I'll draw that in. So something like so. You've also got a new 40-week moving average. This is my weekly chart, so these moving averages are weekly time frames. So the 40-week moving average crossed the 100-week moving average bullishly to the upside. So we've got that cross situation. And we also have noticed, if I take my line here, this was, remember, the resistance line that I just drew in on the daily, and I extend this over. Look at what it catches, everybody. These are prior support. Right? Now, potential resistance. Should we be at all shocked that we paused in this rally at that $70 level? I would say no. So with this in mind, this is starting to look like we might see something longer range development. We obviously have a new uptrend in place. The question is whether can we stick with this for a period? Do we have a new short-term uptrend working? It's always going to be hindsight relative to technical analysis, but this is starting to look like something we could feasibly put ourselves into for an example, and let's see if we have the chance. Now, great question, Rita, would you wait for the breakout before you buy? Good question. this is going to be traders to choice, right? Some of you would prefer to trade it on a short-term basis, in which case you want to see a close over 70 before you establish your position. Alternatively, though, some of you traders would look at that weekly and say, Kevin, I like everything I've seen. We've got support validated, we've got resistance validated, and some traders would say, I'm comfortable with the amount of risk that I could take on. Yeah, I might need to risk 4 to 5 points to the downside here, okay? But they're comfortable with what they've seen in the way of the trend, the new trend that has been established here. So I think we could put this as an example trade. Let's use the 50-day moving average. Let's use our ATR to build in a trade to be a buyer somewhere in the neighborhood of $70 a share. We'll place that as a padded limit. Remember, we are putting a limit that's above today's close so that we increase the likelihood of actually buying. And remember, even though we say a limit of 70, we won't buy at 70 if the price is below 70. We'll get the or better price. So if we are willing to buy at 70, and establishing our downside target below the 50-day moving average, which is 65.75, we need to come below 65.75 by the amount of our ATR, which is 207. So 65.75 less 207 is 63.68. And so that's where we will place our stop order initially, 63.68. Now, I'm going to quickly do the math on this. So we have the risk that we buy at exactly $70, right? Because that's our limit price on this trade. So that means we're risking $6.32 a share. If we are comfortable, confident in the trade, we can take what we would call a full position. Full position would be up to $10,000 worth. Well, here, 100 shares would be about $7,000 worth, and it would get us started. And if we put a stop exit at 63.68, we would walk away, and we got stopped out at 63.68, we would walk away losing approximately $630, which would be less than our risk tolerance. And so that means we're okay to go with a 100-share position. So rather than doing more math, we'll go with that. That fits our tolerance for risk. It fits the trend we're considering. Here's how we can go about placing this purchase. I'm going to right-click in the chart. I'm going to go up to the level that I want my limit at. And this is just to expedite my process a little bit. I'll do a buy custom. And one other thing we will incorporate, let's go ahead and just see if there's an opportunity for us to exit for profit. So yes, we will try to maintain this trade, but the opportunity to exit for profit in a market where things are volatile is not a terrible idea either. So I'm going to set first our initial entrance for tomorrow not to exceed 70, okay? I'm going to then set our good till canceled stop order to the level we've already calculated, 63.68. One thing else about the 63.68 that I do like, everybody, not using a zero or a nickel. Getting off those round figures can help us out a little bit. Going to levels that maybe other traders aren't considering, okay? So using odd numbers is not terrible. And then we're also going to go ahead and put a profit exit up there. Remember, we talked about this being about a $5 range. So if we break out through 70, we might expect to see 75. So let's go ahead and put that as a good till canceled limit. Now, our risk versus reward in such a scenario is inverted here. If we buy at 70, we are risking $6.32 to the downside. And if we get our target at 75 to come through, well, then we've only made about $5 of profit. But again, the view here is simply only because volatility in this market could make a winning trade a losing trade rather quickly. So we're going to try and take advantage of it. If we come back next week and we're above 70 but below 75 and we still have our shares, never a problem with that, right? So let's go ahead and try it. We'll see how this goes. So we're going to hit confirm and send. Make sure I've got the order built correctly, buying 100, not to exceed 70. If we get in the trade, we'll put a good till canceled limit to sell at 75. And if we're in the trade, we'll also simultaneously have an exit strategy for protection. Remember, 63.68, just a trigger, no guarantee of execution at that price. All right, so that'll set us up for tomorrow's business on Archer Daniels. Now, I did have another one that stood out, and it was in healthcare. EW. Now, the reason that EW stood out to me is kind of the size of this range, everyone. We've seen this thing run to this $87 level previous, and it's pulled back. We've seen horizontal support kind of in this 76 area, and we've got this long range uptrend. Let's look at this on a weekly here. Okay, so another one of those situations where we've got a newly developed uptrend. We're above the longer range moving averages, the 40 and the 100 week, and we've got a potential breakout through about 87. The next level of possible resistance is around 95, and that could be a nice little target for us if we desired. So why don't we try and build one here with EW only on a breakout? Okay, so this is going to be a little bit more mathematically driven. The idea here is we're going to want to trade to a new short-term high. The highest we have traded has been 87.89, and it was very limited. In fact, our closing high in here has been just shy of 87. Yeah, 86.85, 86.82, and 87.18. So if we were to trade through 88, we could take a trade, a buy stop order to put us into the trade for what could be a momentum-based move. So this will be a little different. We would only be buyers if we trade through to the upside, $88 above it. We will then set an exit strategy below 88 by the amount of the ATR. Okay, and actually not 88. We will use 87 and go below that by the $2.51. And what that's going to do is, again, give us the opportunity to stick with the trade a little longer. If it's a legitimate breakout, the hope from the bulls is that we don't even come back below the breakout level. Okay, so breakout is at 87, less our 250 means we are looking at, let's see, by my math, 84.50, and we'll go a little below 84.50. Okay, so, all right, so we're going to consider here a smaller position size because a breakout is not a guarantee. So we're going to go with only a 25 share position. This will be a small trade for us, but we're going to do a buy stop at about 88. So here's how this looks, everybody. Buy with bracket. Okay. First thing we got to do, change that to stop. Okay. We'll keep this for, basically this is, well, you know what? Let's do it for good till cancel. This will be good for basically until next Tuesday when we reconvene. We want to see it over 88. So let's just say 88.04. That's a pretty decent ledge. And we're going to do, for a smaller position size, just 25 shares. Remember to make sure your share amounts line up. You can always click this little icon here and that'll line them up. So, okay, and then what did we say our upside was? About 95. All right. So we're going to target for upside 95. And then on our good till canceled stop, we liked about 84.50. Again, that is one ATR below 87. And the reason we've selected 87 was because that's basically been our high close. And so under 84.50, I'm just going to start, incrementally reducing this. Again, just giving myself a little bit more leeway here on my stop exit. Okay. Now, if we get entered at 88.04, get stopped out at 84.44, we would lose less than $4 a share. We only have 25 shares, so we would still be well within our tolerance for risk on this one, everybody. Okay. All right, so here's a confirm and send. Buying 25, good till canceled, stop order. Okay, one more time, we have to trade through or at 88.04. Our execution, once triggered, could be around that price. It could be a little lower. It could be a lot higher. So just be aware, right? We have no guarantee on price. Limit exit at 95 if we get there, good till canceled, or a stop exit initially 84.44 if we dropped to there. Okay, there we are. All right, now in our final couple of minutes, everybody, I just wanted to give you a few of the other ones that kind of made my list today that we did not place example trades on. So quickly, I wanted to highlight Target, because Target has had a new trend here. We've moved through some serious bottoming action. We've had a 50 cross of the 200 to the upside, the so-called golden cross. We've really been working with the 20-day, but you'll notice we've violated the 20 a couple of times. Perhaps the 50 is a little bit more comfortable for some traders. And then I actually did look today in technology, believe it or not. One of the ones that came up on the list for me today was a potential with Motorola. And the main reason for the Motorola one is looking at that big gap move, because you all know gaps have a tendency to provide us with a bit more information, a little bit more validity to price action. And so we could, instead of evaluating the 20-day, some traders might have looked at the recent gap level that had since been maintained. So we had a great move to the upside following earnings. Earnings took a breather, settled in. We went sideways for about 3 days there, 4 days before moving to new highs. And we take a look at where we paused. Shouldn't be shocked by that, right? Happens to be the prior high. So risk versus reward, that one kind of looks intriguing, because your risk might be down to 448. You're risking somewhere around 20 points, and your upside opportunity goes to about 490 if you're thinking it can get back to where it was. So you're looking at about 26 points of upside. Still less than ideal from a risk versus reward stance. But we can always make a trade work if we massage our entrance point a little bit, or maybe the number of shares that we're considering. So I wanted to bring both of those to the table for you today, just as examples of what I was kind of thinking through in my pre-work with you before stepping into class. So, all right, we're going to go ahead and wrap it there. But as a review of what we've done, we did hit the major indices. We looked at the S&P 500, the NASDAQ 100, and the Russell 2000. Taking note of today's afternoon swoon, what seems to be tied to the moves up we've seen in oil off today's intraday low. We did revisit all of our stopped out positions over the last week. We had 4 of those. We did maintain 2 positions in our example portfolio. We elevated the stops on one of those and kept the stop on core mining the same to give it another opportunity, another week or so. We tried 2 new trades today, 2 new example trades in EW and Archer Daniels. Hopefully these are positions we get put into tomorrow or any day, the remainder of this week perhaps, and then we'll have some more to discuss with you next Tuesday. So I realize, for some of you, this class might be, we may have jumped right into things a little bit today. I hope it wasn't too much for you, but remember that this class has been, I started this one in January. If you go into our archive for this class, you can go all the way back to the very beginning when we just got our feet wet, building the portfolio, reviewing our account process here, max position size, risk tolerance, all of that. I hope you all find that to be helpful for you in building your own example trades and working through your own process a little bit. Remember, the best thing we can do as traders is to plan our trade and trade the plan we set for ourselves. So hopefully you're all following along that way as well. All right. Thank you, Connie, for being there in the chat. Really appreciate you getting to questions I was unable to address. Make sure you're following both of us on X, Connie Hill CS, Kevin Horner CS, and make sure you're subscribed to the channel as well. Last note, if you like today's discussion, hit that thumbs up button for me. We get these reviewed and into the archive as early as tomorrow morning, most likely. So that thumbs up will help us out in the YouTube algorithm quite a bit. So with that, I'll let you have the rest of your Tuesday, everybody. Hope it's a great one. I look forward to catching up with you again real soon.